this whole Bitcoin halving narrative, I spent a long time looking at it, and I think it's factually incorrect.
And some people are going to really not like me saying this, but I do feel that DeFi is still in its V1 stage. And there's really awesome innovation and there's indications of what can be there. But I think we will look back on a lot of DeFi as we know it today to be, I don't want to use an insulting word here, but, more proofs of concept that grew up over time. And we've been speaking with a team called Infinity Exchange, and they've been blowing my mind, I would say. The leader of it is this guy, Kevin Lepso, who was head of structuring at Morgan Stanley from 2006 to 2011. So through the financial crisis, through max complexity, and he gets DeFi and the importance of, say, the transparency, the assets being on chain, but he also, looks at a lot of the inefficiencies. Let's say if you look at the spread between borrow lend on Aave, it's like, I think I was just looking at ETH the other day. I think it's 4% to borrow and 2% to lend. So you got a 200 basis point spread. And it's kind of like being able to buy Bitcoin at 40K and sell it at 20K. Those spreads are never going to work for institutions or power players. And that's just one example. I think that, the spreads are much tighter in exchange. But, one of the things here is, and this is from the conversations with Kevin, from who I've been learning a lot. So crypto right now, they're more equity-like instruments than they are bond-like instruments. And the bond markets are much bigger than the equity markets. And because of that, we don't have yield curves really in crypto. We don't have continuous yield curves. There's a team we work with called Element that is working on parts of this. There are people who are working on parts of this.
The Shanghai fork is going to help on ETH.
Yeah, that'll help. And you're seeing signs of people playing with the idea of yield more, and not degenerate yield, but real yield, as you point out. But we need much better borrow lend markets. 2022 taught us that. And even the DeFi primitives that survived, and that's great, the spreads are way too wide. Those need to tighten. I would say that stablecoin yields need to achieve, close to parity with the yields we see in traditional finance. Like, okay, maybe an extra 10, 20 basis points or whatever you want to apply to, idiosyncratic crypto risk. But those yields need to come together. Also, custodying real world assets and generating stablecoins against those is another thing that we don't really have to start to really grow the crypto pool. So, but those are kind of more red tape, stodgy, quote unquote, boring institutional things that requires a different type of founder, I would say. And so I think that we will see more of this hybrid or institutional DeFi come in, built more by, say, combinations of teams that came from Wall Street or traditional finance with strong coders who speak the language of traditional finance. Because traditional finance, there's some experimenters like Jump or whatever, but most of them, they just can't get over the line on too many things with DeFi as it currently exists.
So what's super interesting is Alan Howard's a good friend of mine, Brevin Howard Digital. They're huge now as a hedge fund. And what he did is he moved his money market and emerging market traders to run the DeFi books. Because he said they completely understand it and they understand how to arbitrage it and all of that. But, I've got this crypto fund of hedge funds called Exponential Age Asset Management. And what we found is basically at this current market, there's probably about $4 billion in hedge funds, maybe 5 in liquid market strategies. I mean, there's no money. 3 trillion in traditional markets in hedge funds. So what you've got is that tier of people creating liquidity. It's just not there. So there's a few guys like you who are doing, mainly directional stuff. So we got Polychain and a few others. There's not that many arbitrage funds yet that will tighten up all of these spreads and make all of these system things, the relationships between different crypto assets and stuff. It's just not there. There's no capital.
Yeah.
But I think it will come. I think the capital will come, and the next wave will see a lot more hedge funds into the space that will start arbitraging spreads and make it more liquid for other people to use and more robust and stable, I think.
I agree with that. And again, this is pulling from conversations with Kevin, but some of it is there aren't good ways to hedge out duration risk, and without, really robust yield curves and borrow lend markets with tight spreads, there's too much risk, I would say, for an arbitrager to come in and do their job while hedging out the exposures they don't want. So there are some, I would say, fundamental pieces of infrastructure that still need to come into play that are probably going to be built in more hybrid DeFi environments that will allow power players who truly operate at scale to come in and do their work.
Yeah, my view on this has been ETH staking yield was step one, but that was 1 year yield. And then you had to take illiquidity risk by taking Lido or somebody else, and it's a mismatch, a duration mismatch, which is always a problem, right? Because it can go horribly wrong. But after the Shanghai fork, basically anything out to 1 year is now liquid. So now we can have a money market curve at least. So we can have a 3-month rate of money, a 6-month rate of money, a 1 year rate of money, an overnight rate, all of that. That's going to help a lot. Okay, it doesn't give us an option market that goes beyond a year yet. You can, but you've got a lot of risk, as you point out. I think this is a big deal. And then somebody will set a longer term benchmark duration yield at some point. But it's probably still too new as an asset to have that. But it feels like it's interesting. And my guess is it will price somewhere like the Treasury curve, because all money is fungible in the end. There's some relative fungibility between, a US Treasury and ETH.
Right.
So I think that's how it'll end up.
That makes sense. And I mean, the last bull market, I would say, was crypto playing with this idea with fire.
Because it's manufactured yield. That was the problem.
And so it was, it was us more in our juvenile state, with hairspray and lighters and, just torching everything and taking things to excess. And I think that, or at least my hope is that the next expansion is a more mature and refined approach to these really important components of finance.
So you got very interested around the lows from that June to October period as crypto was basing. What got you more focused over that period? And then we'll come into Solana, because I thought that was very interesting. Yeah. But what got you focused? Because you've been through a cycle before. There's a lot of people who haven't. You kind of know how it plays out, and you remember it. And your tweets were quite funny because it's just reminding people of what they were like back then, and it was exactly the same mentality.
Yeah,
it's all going to shit.
It never changes. I mean, when I really started paying attention to crypto, it was in the 2014-15 bear for Bitcoin. And then that's when ETH was launched. And so from that bear to the 18-19 bear to the 22-23 bear, there's just certain patterns that pop up a bunch. And there's the psychological ones of, and this is where Twitter's a really powerful tool, but, when a asset is really low and people are calling for zero in the case of Sol, or, 10, 12K in the case of BTC, and not honoring the fact that it's showing some strength, that's an indicator to me.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.